bear markets, bull markets, hedging, blue chip companies, trading and broking. To most, the stock market is mysterious. We've all heard of the terms, but what do they really mean? The stock market is a term that conjures up a bevy of emotions. It can be associated with risk, excitement, wealth, ticker boards and trading rooms. For most of us, the thought of living the life you want to, whilst the market simply grows your money, is a pipe dream, and quite frankly, an unrealistic one. Well, I'm here to tell you that if this is what you think, you'd be wrong. My name is Marcus de Maria, and I've been investing and trading the markets for over 17 years now. And for about the last decade or so, I've been training thousands of others to do it too. In this three-part series, I will be taking you on a journey in which we peel back the covers on an overly mystified industry. I'll be giving you tips and strategies, meaning that by the end of the series, if you've paid attention and are willing to take action, you will have the tools you need to start trading too. In the last episode of Stock Market Secrets, we explored different stock market strategies that you can apply right now. 2 of which were investment strategies and 3 were trading strategies. And as we discussed in the last episode, the major difference between these 2 types of strategies, investment and trading, is that investing is about time in the market, while trading is about timing the market. In this final episode of this 3-part series, we're going to be looking in detail at my favorite strategy, the Buffalo strategy. We will also be looking at another piece of stock market magic known as shorting the market. The basic concept behind the Buffalo strategy is to spot a channel pattern and trade that channel as the stock prices rise and falls between the support and the resistant lines. Remember, this is an opportunity to benefit from the market as the stock rises and falls, and you can make money in both directions. Using the skills we developed in the last episode of identifying support and resistance lines and spotting a channel pattern using the rule of 3, it is now time to start trading. The first method of trading a sideways moving channel is to trade while the stocks is going up in value. Once we've identified a pattern, we are primed and waiting, ready for the stock price to hit the support line. When it hits the support line, now is the time to buy, and by locking in the price at the support line, you will benefit when the price then starts to rise. At this point, you have made a trade, and you have traded your hard-earned cash for shares of a company at a price you expect will rise. Now what we need to do is to sell the stock to release your cash again. This is where we wait for the stock price to rise back up to the resistance line, and it is at this point you sell. The principle behind this strategy is that you have bought the shares in a company whilst the value of those shares is low, and you have then sold them when the value is higher than you have bought. Once you sell, you then receive more money than what you have paid for them. Easy. Now, the majority of you are probably thinking that once you've sold your shares, you now need to wait until the price returns to the support line before you can buy more shares and benefit again. Well, you'd be wrong. And to demonstrate, here comes Dave. Thank you, Dave. My friend Dave there has recently bought this fantastic Range Rover Sport. He absolutely loves it. The thing is though, Dave travels a lot on business, and unfortunately, even though he's just bought this awesome car, he needs to go to America for 6 to 12 months. Because he's my friend and he knows that I'm trustworthy, Dave has asked me to look after his car for him,
drive it around a little to keep the engine running and the battery charged, and keep it in the garage. But not too many miles on the clock, so it's pretty much the same when he comes back to as it is now. But I've been thinking, yes, the car will be almost exactly the same as it was when he left, but what will have happened to the value? If I know one thing about the car market, it's that generally, in most cases, the value of the car will drop as time goes by. By the time Dave gets back, his car could have lost anywhere between £5,000 to £10,000 simply into the universe somewhere, just with the passage of time. If only there was a way to capture that lost money. Fantastic. The kind man in the dealership has given me £50,000. Result. Now I know what you're thinking. How could I do that to Dave? He trusted me to look after his car and I've gone and sold it. Well, yes I have, but I do have a plan up my sleeve. Well, that went well. I was able to buy pretty much an identical car. It has just a few extra miles on the clock, as good old Dave would expect, but other than that, is exactly the same. But do you know what the best thing was? Because the car is 6 months older now, it only cost me £42,000. Dave has his car back now, but what I managed to do there was capture the value of depreciation without even owning anything. But why would I bother telling you this story? Well, you've probably heard the term, but are likely to have not known what it really means. A hugely powerful tool and quite frankly a piece of stock market magic we have at our disposal is called shorting. When you believe a stock is at the top of its price, you can hit the sell button even if you don't own any stocks. What happens is similar to my analogy with Dave's car, but in reality you don't need to know how it works, just that it does. It's your broker's job to make all the magic happen. But the result? Well, coming back to our channel pattern, when the stock price reaches the top line or the resistance line in the Buffalo strategy, you hit the sell button. In other words, while most people are losing money when markets go down, we are actually making money. Most people don't understand how to make money when markets go down, which is a shame because they're missing out on almost double the trading opportunities and chances of cashing in. Remember the lift analogy from our first episode? Now, some people get confused by this concept, but in reality, if you look at the graph above, we are still buying low and selling high. And when you do that, you make a profit. Normally, we buy first and then we sell. When we make money going down, we sell first, and as it goes down, we then buy it back. Can you see that in this way, we are still buying low and still selling high? Only we're doing the selling first. I told you, magic. Coming up after the break, I'm going to be going one step further by explaining to you what a vertically moving Buffalo stock is and how this can also be a great environment for trading. In addition to this, I will also be showing you how you can actually start trading right now from the comfort of your living room with your laptop and nothing more. Before the break, we went into detail about how to use the buffalo strategy to trade in channel patterns. We also used Dave's car to reveal one of the hidden gems of the stock market, being able to short a stock. But in this part of the show, I'm going to explain to you how to trade in a vertically moving buffalo stock, and also how you can start trading right now from the comfort of your living room. Some buffaloes don't just go sideways horizontally. Some actually crawl up or down and turn into vertically rising or falling buffalo stocks that look like a big caterpillar. Trying to time vertically rising or falling stocks is more complicated than sideways buffalo. This is because with the sideways buffalo, the lines stay the same, and once you know your entry and exit points, they tend to stay the same. With the vertical buffaloes, the challenge is that the line moves every single day. Let's take a look at the chart on the screen. This company's price chart goes up and comes down, but the general direction is up. Notice how the highs get higher and the lows get higher. This means it is trending up. We can draw a vertical line at the bottom of the lowest points, and we notice that the price seems to obey that line as if by magic. If it had just touched it twice, then this might indeed have been a coincidence. But when it comes down again and again to the line, and this is seen in stocks all over the world, then this cannot be mere coincidence. Remember, it took 3 spilt coffees for me to spot a pattern. In our experience, the same people all around the world are looking at this same stock. They have all drawn the same lines. And when the price comes down to the line, what do you think they are looking to do? That's right, they are looking to buy. It becomes almost a self-fulfilling prophecy, and this keeps happening until one day, well, it stops happening. Either because the stock breaks up to the upside or down to the downside. What is great about vertically rising stocks is that the moves can happen quite fast. Why? Because it has momentum to the upside. With higher lows and higher highs, you are already increasing your chances of making money because the trend is up. And if you buy, you're going with the trend. This is an important lesson. Always trade with the trend. That is why if we see a trend that is down, we don't buy into it because it might continue down. And we don't know for how long, so we like to ensure that we go with the trend. Sometimes we see the same formation as stocks go down. If we look at the price movement on the screen now, we can see a vertically falling buffalo stock, much like a caterpillar again. Can you count the number of bounces it had coming down on the vertical line? If you counted 4, then that is correct. And again, we can either try to get in on the 3rd bounce using a stop order, or wait until it comes back again to the line and then sell short. And remember, if you go with the trend, you can make money fast. In fact, not only are the lows lower and the highs lower, but generally you can make money faster when markets go down. Just look to see what happened in May. Can you see how the price jumped down from when it touched the line? This is called gapping, which means that a large player sold overnight, and when the market opened, the price was substantially lower. Rest assured, you can make money whether markets go up or go down. You just need to know which button to press. And some risk management. Are we going to make losses? Of course we will make losses. However, remember the number 1 rule we established in the first episode? Due to the fact that we use tight stop losses of just 1% of our total investment bank, but we let our profits run, we make sure that our gains are much larger than our losses, thus more than covering any trades that may have gone into a loss. Do you remember the amount of times you would have to be wrong to lose all of your money with a stop loss of 1%? Do you remember? 100? No, 462. There are broadly two types of people who can benefit the most from the stock market. Firstly, the kind of person who wants to know how to make money in stocks. They are likely to be thinking that their job just isn't giving them quite enough cash flow to do what they want in life. So, the first person simply wants more cash flow. The second person is someone who's looking at their retirement and then looking at their pension and thinking that their pension isn't big enough to look after themselves and their families. So the second person wants to grow their wealth. With the correct strategy implemented well, the stock market can be a fantastic environment to achieve both of these objectives. And the great news is that it doesn't have to take up all of your time. I've been trading and investing on the stock market for the last 17 years, and on average I probably spend between 20 and 30 minutes a day evaluating my current positions and moving them if I need to. This doesn't have to be your full-time job, and it doesn't matter when. It could be the mornings, the lunchtimes, or the evenings. A second huge benefit of the stock market is that it is a way that you can make money from wherever you have your laptop and a good Wi-Fi connection. In fact, these days, I would take that a step further and say your smartphone and good signal. All you really need to do is to Google stockbroker and you will find a lot of sites where you can trade. There are lots of review sites, so use these just to check which have the best rating.
In this series, we visited the Bank of England, the London Stock Exchange, skyscraper buildings, and even buffaloes themselves. We've talked to traders and learnt strategies, but this series comes with a warning that past performance is not an indication of future results, and investing carries a large degree of risk. You could make money, but you could also lose it. But what I will say is that there are lots of opportunities out there. You just have to take them. And the only real bit of advice I'm going to give you is that there are a lot of different groups and a lot of different people that you can get involved with. Follow them and learn from them. Get tuned into this information and benefit from the knowledge. I'm Marcus de Maria, and I hope you have enjoyed the series.